All right, good afternoon. It's now noon here in Boston, and we're going to be getting going in a moment for our webinar this afternoon on family and philanthropy, tips for annual giving. My name is Christopher Cahill. I'm a principal in the Family Office Services Group at 12 Points Wealth Management. Thank you for taking the time to join us today. Looking forward to any of your questions. As you know, there's a chat button on the GoToMeeting webinar here. So if you have any questions throughout the program, just please chime in and I'll do my best to answer them. If for whatever reason I can't answer them today, I'll follow up with you afterwards. Thank you very much for taking the time out of your busy day. I'm going to get going right away so that I can be respectful of your time and get you back to the things that you're going to be doing today. So there's my smiling face, Chris Cahill. As I said, I'm an attorney, a certified financial planner, and a chartered advisor in philanthropy. I have the distinct pleasure of being a principal and partner here at 12 Points Wealth Management in Concord, Massachusetts. Joined the firm in January of 2016. Very excited to be part of this organization and looking forward to helping you understand the tools and techniques of giving, both for charity and for family here. So today we're going to address the most common ways to make gifts. Most folks tend to make gifts via cash, and that's certainly one powerful way to give. We're going to talk about some others today as well, but I think that this slide really encapsulates a lot of the things that we're going to talk about. So whether it's donating to charities or gifting money to loved ones, we'll teach you the tips and tricks to make the most of your generosity, going far beyond simple tax deductions. So what we're going to discuss is the traditional giving of cash. We're going to talk about the benefits of appreciated stock, dealing with more complex assets. We're going to talk about how to maximize your gift and minimize your tax, and how to help the children, grandchildren understand the values of money, and how to give thoughtfully to family members as well. So we're going to start with charity. So it's November 20th today, and we're fast approaching the end of the year. So this is when many folks are starting to turn their attentions to those philanthropic causes that they're attached to and committed to, and begin thinking about making those annual gifts. So let's talk about how that can happen. Why do people give to charity? Well, they want to give and make an impact. They want to leave a legacy. There's a cause that they're committed to. Candidly, making gifts to charity just makes us feel good as well. So this is a great time of year to gift. We've had a pretty good run in the market up until relatively recently. Particularly today, we have another down day in the market, but largely speaking, those that have been invested broadly in the market over the last decade have some pretty significant gains. If you were to take an asset that had gain and contribute it directly to charity, you're going to make a greater impact. You're going to avoid the capital gains tax on the asset that you move to charity. They're going to get the benefit of being able to sell that asset and get 100% of that value and that dollar in their pocket. And candidly, there's a tremendous amount of need out there now. So this is what I would submit to you, and this is why I would submit to you that it's a great time to give. So let's talk about how charitable giving impacts your taxes. So 2017 Tax Act made some significant changes to the world of philanthropic giving. We actually have a situation now where you're not going to be able to deduct those charitable gifts that you used to make unless you itemize. When will you itemize? You'll itemize if your itemized deductions exceed the standard deduction. The standard deduction has increased and twofold, so it's now double. So for a family, the standard deduction now is $24,000. So what does that mean? If you're not making rather significant charitable gifts, and if your other itemized deductions, your traditional itemized deductions, such as interest deductions, mortgage interest deductions, things like that, don't exceed $24,000, you might not, in fact, get the benefit of a charitable deduction on those gifts. That's an unfortunate reality of the world that we live in now and the tax law changes that came into being. When I went through the Chartered Advisor and Philanthropy program that I did over the last 3 years, one of the continuous mantras of the organization was that people give because they care, not because of taxes. I always said, I hope that's in fact the case. I don't want to try and prove that out. Unfortunately, we're at a world today where in many instances, those checkbook giving, those annual gifts that many make to local charities may no longer be quote unquote tax deductible to them. So will that impact them? Will that prevent them from making those gifts? I hope not. I think we're going to find out. We don't really know yet. There's a lot of studies that have been out there that have indicated that charities are continuing to receive substantial and significant gifts, and that's great, and I hope that's the case. But I really don't think that we're going to know until probably 2020, and the reason that I say that is a lot of folks don't realize the impact and the changes of the 2017 Tax Act. So as a result, they're not going to really know how the changes impacted them until April of next year, right? So April of 2019, there might be a rude awakening for some folks that thought that gifts were deductible when they weren't, and that might impact how they decide to move forward going into 2019 and beyond. So that's why I say we might not really know until 2020. But having said that, if you're on this call today, you care, you want to give, that's a great thing. So typically, cash contributions have to be documented. These are important functions of the charity to make sure that they're going to substantiate the gifts for you with a written acknowledgement. Any gifts over 250, the gift has to be complete. These are realities. You can't give a contingent gift. It has to be a complete, full, and full transfer of all ownership interests. Appreciated assets results in a deduction based upon the value of the asset, but you also avoid the capital gain. So that's a big issue. We're going to talk about that in more detail in a moment. Deductions can be and are limited based upon the type of gift, the type of entity receiving it. So cash is typically deductible up to 50%, now actually 60% of AGI through the 2017 Tax Act. It used to be 50%. Excuse me. So that's a material benefit to giving cash this year, actually. Giving appreciated assets, typically the deduction is 30% of adjusted gross income, but it can be reduced to 20% of AGI based upon the entity that you're giving it to. So if you were giving an appreciated asset to a donor advised fund, it would be a 30% deduction of AGI. If you were giving a appreciated asset stock to a private family foundation, for instance, it would be a 20% deduction on AGI. So really just depends upon what you're giving and who you're giving it to. So, traditional gifts, most people give cash. According to Fidelity's charitable arm, 79% of donors give cash. Kind of surprising to me, to be honest. Of course, organizations like cash, it drops immediately to the bottom line. It's not the most tax efficient way to give, though, and if you do have appreciated assets, there's definitely a benefit to utilizing them for that purpose. So you can certainly make those checkbook gifts. Organizations do love them. They do need to document them and give you a receipt acknowledging the gift. And that's really just the reality of that world, is that they need those cash gifts to keep the lights on and to pay the bills. More substantial gifts tend to be oftentimes come in in different forms, whether it's in appreciated stock or other assets, real estate or business interests, things that are a little bit more non-traditional, if you will. So we spoke about appreciated stock a moment ago, but giving appreciated stock not only provides for the charitable deduction, again, assuming that you're above the current deductibility levels that we just discussed a moment ago, but it'll also avoid the capital gains tax. So you really can get a benefit here. So this example is very simple, but assume for a moment that you're in a 28% bracket and that you're going to consider contributing $10,000 in either cash or appreciated stock to an organization. So cash gives you a contribution of $10,000, saves you $2,800, in income taxes. So the after-tax cost of that gift is $7,200. On the other hand, if you gave $10,000 of appreciated equities, you'd still get that income tax savings of $2,800. But if you had an $8,000 gain, hypothetically, you'd save again that capital gains tax embedded in there of $1,200. So in fact, your after-tax costs of that gift would be $6,000, which is substantial. So the savings there. I think that's a good example of the reality of giving appreciated stock. You avoid that capital gains tax. One thing to remember, though, is that you can't roll into a charity middle of December or end of December and say, hi, I've got appreciated equities I want to give you. They typically have a cutoff of around December 13th or 15th. They need to process those gifts. It's not as easy as taking a cash gift. So just be aware of that. So if you are contemplating making a gift of an appreciated asset between now and year end, you're probably going to want to be more thoughtful and start thinking about it seriously right now. So more complex asset, right? Complex assets. IRAs are a fabulous giving tool right now. So the 2017 Tax Act made permanent the IRA charitable distribution, qualified charitable distribution. So you can contribute up to $100,000 from an IRA directly to a charity and avoid all income tax on that asset, and it will suffice and be applied against your required minimum distribution. So what that means, in essence, is if you're fortunate enough to have a large IRA and you're philanthropically inclined and you're staring down the barrel of a required minimum distribution of maybe $120,000 a year, and you have substantial assets outside of the IRA such that you don't really, quote, need that $120,000 of taxable income coming to you, you can take up to $100,000 and move it directly to one of your favorite charities, and then take that balance, that $20,000, out as the balance of your required minimum distribution. So you'd pay income taxes on the 20, the 100 would go directly to charity. It would accomplish the objectives that you want. Really, really a great strategy, and one that is becoming ever more important and increasing in popularity in the world of philanthropic giving. So more complex assets, non-publicly traded assets. So if you've got a private asset, care needs to be taken. You have to be really careful about how you do this. And you have to make sure that the organization will accept that sort of asset. Same sort of thing with real estate and life insurance. These organizations, they're not in the business of running real estate or being a shareholder in a private company, or candidly managing life insurance policies. But at the same time, these assets can have tremendous value. If that's the case, they will want to take them on. The smaller the organization, the less able to deal with these assets they'll be, as you can imagine. But assuming you're dealing with an organization that's got some heft, they'll readily be able to take on these assets. So, being thoughtful and savvy as it relates to contributing these more non-traditional assets is really, really important. Again, it's not the sort of thing that you're going to try and pull off between November 20th and the end of the year, most likely, but it's certainly something to contemplate for next year. So, other charitable planning gifts, how to coordinate your philanthropy with your estate planning for a greater impact. This is really where the rubber meets the road for the majority of the work that I do. If you were to envision a Venn diagram, one circle being labeled estate planning, another being labeled financial planning, and then the third being labeled philanthropic planning, that intersection where those three bubbles intersect is really where I reside, where I spend the majority of my time, is helping people coordinate their estate, their financial planning, and their philanthropic planning objectives. These are some of the tools on the screen now that we utilize to help families accomplish these objectives. Donor advised funds, really great planning techniques. These are allow for a gift now and an ability to make contributions into the future. So you don't need to identify the organizations today that you're going to be gifting to. So you could literally just make a big gift to a donor advised fund and let it cook and figure out where you're going to target those assets to in the future. Donor advised funds are run by a number of different organizations, places like Fidelity, Charles Schwab, community foundations here in Boston. The Boston Foundation has a very well-respected donor advised fund, as does the Foundation for Metro West out in Natick. Any number of organizations run these, and they're very, very efficient from a perspective of giving. I'll talk more about them in a moment. Private family foundations, certainly more complex strategy. This is in fact an entity rather than an account. But if you have substantial wealth and you're really interested in being more connected to the giving program and the strategy, a private family foundation can be a great tool. There are certain differences between a donor advised fund and a private family foundation that I'll talk about in a moment. But suffice to say that they're kind of accomplishing similar sorts of objectives. They're either an account in the form of a donor advised fund or an entity in the form of the foundation that's going to receive the gift and then be able to use that gift going forward for the various philanthropic causes that you or your family have identified. Charitable remainder trusts, great techniques. These are, just as you can imagine, a trust whereby you'd put assets in, you'd receive an income interest or an annuity interest for a period of years, and then the remainder would go to charity. So if you had a desire to supplement your retirement and you had an appreciated stock, maybe that appreciated stock wasn't paying a dividend or not a substantial dividend, you could contribute it to a charitable remainder trust, get an income tax deduction, and then get a larger income stream out of that asset because it could be sold inside the trust and repurposed without a capital gains tax, by the way, and provide an income stream to you. And then at the end of the day, after you pass away, the asset goes to the charities that you've identified. Really a great technique. The charitable lead trust is a similar spin on that same sort of thought. In this instance, however, the roles are reversed. The income, the lead interest, if you will, goes directly to charity for a period of years, and then the remainder interest reverts back to your heirs or your family members or to a trust for their benefit. Charitable gift annuities, these are entities that are, annuities that are created by a series of nonprofits. It really provides the opportunity for you to give to a nonprofit, and they'll provide you with an income stream for life. So it's a poor man's remainder trust, if you will. The charity's going to give you the income interest for your lifetime, and then at your passing, they'll have the balance of the asset to utilize as they see fit. Definitely a good planning strategy as well. So the donor advised fund allows you to make a gift now, As I said, it goes to an account at a Schwab or a Fidelity or to a community foundation, as we discussed. You're going to get an income deduction now. You're going to be able to designate the charities as to who's going to get that contribution later. So in essence, it works like the foundation without the headache and the paperwork. There's no, currently under current law, there's no required distributions out of these donor advised funds. Family foundations have a requirement that they contribute at least 5% of their fair market value on an annual basis. The donor advised funds don't have that requirement currently. There is a move afoot to try and push that, but until that happens, you could accumulate the assets here in the donor advised fund. They are a great tool for year-end planning because you can establish one really quickly and move the assets over there very quickly. So hypothetically, if you had that appreciated stock and you wanted to get rid of it and it's now December 28th, going to be hard for you to get that to a nonprofit that would be willing to accept it and have it be credited for a 2018 gift. You could easily set up a donor advised fund on the 28th, transfer the assets over there, and have that be an accomplished, completed gift for 2018. So keep that in mind. We're big fans of the donor advised fund here at 12 points. So, gifting strategy. How to enhance the family, how to engage your family in your philanthropic giving. This is one of the things that is of most interest to many of my clients and people that seek us out. They're really just trying to figure out how to develop a mission, how to develop a vision for their family's philanthropic donations and inclinations. So you need to really sit down as a group and figure out what you're passionate about. What are your heirs passionate about? Those things might be the exact same. More often than not, they're going to be different. So then how do you address that? I've had a bunch of situations where we've had family members that are just at odds as it relates to certain causes. The solution was very simple: to set up two different funding vehicles, or two different donor advised funds or family foundations to address those different causes. You know, it really is important to have those conversations to get to the heart of what is important to you about your wealth and what you want it to mean and what legacy you're trying to leave. One of the best ways to go about that is to literally just start volunteering together, figuring out if there's causes that you care about as a family that everybody can get behind. Family matching gifts are really, really important. Giving the children or grandchildren a set amount of money that they can contribute, and then say that you're going to match whatever gift that they do. So that helps them begin to learn how to vet and qualify a charity for giving. So from there, they can see the importance of the gift themselves. They can get connection with an organization, and then that gift can be multiplied through your donative intent. And the reality is you need to have some patience too, because some people will take to this very, very quickly and it'll be something that they'll gravitate towards. Others, it might take more time. So just be cognizant of that and that you can't really rush it. So these are two good examples of books on charitable giving as it relates to families. The Opposite of Spoiled, written by Ron Lieber, and The Generous Gene by Susan Price and Juliana Price. So these are two excellent books. We highly recommend them to our clients when they're trying to figure out the best ways to engage their children with philanthropy. So we're going to now take a pivot and start talking about ways to give to family. So, ultimate question: when do you want to give, right? You have really two choices. You can give during life and you can give at death. So many people choose to give during life. They want to see the impact now. They want to address a current need. They want to help the children or grandchildren understand their values and give them a test, see how they handle assets. And, you know, maybe that'll keep the fire in their belly. They'll get the taste of the wealth. They'll understand that they need to continue to work hard themselves. These are really important components. There's a quote here from Plato that I think is appropriate. Let parents then bequeath to their children not a heap of riches, but a spirit of reverence. Should be relevant as well, obviously. Really important to find what's important to you as a family of giving now versus later. So, tools and techniques. We have a $15,000 annual exclusion gift. You can give $15,000 to any donee. That can be doubled if you split it with your spouse. Those are what we call the annual exclusion gifts. Things that don't qualify for annual exclusion gift treatment: direct payment of tuition and medical expenses. So you can do that without any limitation. And then if for whatever reason you want to gift more than $30,000 and you're not going to be making a direct payment to tuition or higher education or paying medical expenses, you have your lifetime exemption, which currently is in excess of $11 million. So in reality, you're not going to likely have any taxable gifting going on. Excuse me, I'm coming off of a cold. So gifts to family, outright gifts. Traditional, here's a check, Happy Thanksgiving, Merry Christmas, here you go. Certainly a tried and true tactic. Obviously, you want to make sure that the recipient of that gift is going to be prudent with it, not blow it, or put themselves in harm's way, even worse. You can make contributions directly to savings accounts. You can utilize 529 plans for college savings. Great tools and techniques there. You can pay off loans for individuals. You can make loans to them. The loan regime really works well. It allows them to get the asset if they need to pay you back, and allows them to get some prudence and some standard budgeting techniques both under their belt. And then, of course, my favorite, the irrevocable trust. I love to utilize trusts. Putting assets in trust really preserves and protects them and helps prevent you from having a situation where the assets are diminished or lost due to creditors, predators, or divorcing spouses. So, estate planning. Year-end is a great time to revisit and review your estate planning. Do your documents accomplish your objectives? It's amazing how often I run across a client that hasn't looked at their estate planning documents for more than 20 years, and the objectives in those documents are no longer anywhere near what their current objectives are. So you really want to pay attention to this. I think it's an appropriate time to focus on estate planning at year end, really kind of look back retrospectively at what you've created over the year and years, what you're trying to accomplish, what you're trying to do going forward. Are the trustees and executors in these documents still appropriate? Are the guardians of your minor children still people that you want to have be in that role? These things can change, as we know, so you really want to pay attention to it. And then, are the assets going to be properly protected from those creditors, predators, and divorcing spouses? More often than not, they're not. What do I mean by that? Most estate planning documents I run across these days have outright distribution schemes. Children get a third of the assets at 25, half at 30, and the balance at 35. Well, guess what? As soon as the kids get control of those assets, they're subject to the claims of their creditors. They could be subject to lawsuits if they're in a particularly litigious industry, or if they get in an accident, or for whatever reason. And then certainly if they get into a divorce, those are now marital assets and potentially subject to division. So, you know, what you want to do, I think, is keep the assets in trust for your beneficiary's lifetime with a discretionary trustee that can make distributions out of income and principal at their discretion for the health, education, maintenance, and support of those beneficiaries. Those are really important things to contemplate. In many instances, it requires a full redo of the documents. That's fine. You haven't done them for a number of years. Pay attention to it now. Protect your family. Protect the ones that you care about. This is in essence your last gift. You want to make it count, right? So that's kind of around the world with what I was hoping to accomplish today. I told you I wanted to be respectful of your time. So a half hour in and out. We've spoken about the intricacies of gifting to charities and to individuals. All of our webinars are up on our website at 12pointswealth.com//webinars. You see my contact information here, Christopher Cahill. I'm happy to speak to you at any point in time if you have any questions as it relates to philanthropic giving or gifting to your family or heirs. I'd love nothing more than to talk to you about those sorts of items. So please reach out. Thank you for your time and enjoy the balance of your day.